inter-month price differentials. And that's sometimes we call it the price of storage, which gives you an indication as to the value of storage from one time period to the next. In a normal market, that's positive. In an inverted market, such as on the right-hand side, it is negative price of storage. And when we have a negative price of storage, what it's really saying is don't store the commodity, that the value of storing it forward is negative, so you should not be storing the commodity. This is very, very important concept in commodity marketing for everybody in the marketplace, but particularly for those growers in this industry. This is an elaborate theory behind it, and I don't want to elaborate too much on this, but this shows on the vertical axis the price of storage, and the horizontal axis is this level of stocks in the marketplace. Now, a few years ago, we had a very, very high level of stocks, and the supply of storage is way out here, which would imply a very large positive price of storage. In today's world, we have a very, I hate to say it, but a pretty tight level of stocks, even at 0.10%, which puts us about right here, which means that implicitly the price of storage is a pretty small number and prospectively negative. So here's the values as of yesterday. These show the current futures prices as of yesterday for each month going forward, all the way through March of 2020. You can see the nearby was 893 and everything else was a discount to that. And if we tabulate those up, this shows the cumulative price of storage, and they're all negative, so it's a no-brainer. As farmers, you probably shouldn't be storing the commodity. In my calculations, as a rough value, I use 5 cents per month for storage. Frayne can give you more detail on that. But what that means, the net returns to storage, if you store the commodity forward from now until March, is a large negative number. And I'm hoping a message here, and hoping Jim would speak to this and Frayne can talk to it later on, is that in today's market condition, storing the commodity probably is only relevant if you're extremely bullish in the underlying futures market and or the underlying basis market. Here's the history of the price of storage. You can see this is the November minus August price of storage. We peaked out here in about early June at about 10 cents, and since then it's been declining. And so this is how we kind of keep track of this. And now it's really a negative movement in the underlying price of storage. The second concept I want to talk about is basis. And the basis, here's my representation of the taxonomy of markets. When I first started teaching, all we had talked about was the futures market and nothing else mattered. And the reason for that is probably because the basis hardly ever changed. And so all we had to worry about that was changing was the futures market. But in today's world, we have a lot of changes in the basis, and the basis is impacted largely by the rail markets. So in reality, we have about 4 markets operating contemporaneously at any one time, including the options market, futures markets, cash markets, and the rail markets. And the rail markets impact the cash markets. The difference between the cash and futures is the underlying basis, and that's what I'm going to talk about today. So the major factors that impact the basis are the delivery mechanism, location, time, and quality. I'll speak to each one of those, and then I'll show you some current graphs. So in theory, we think this is the way the basis is supposed to behave. And to be honest, it behaves pretty much like that in the case of northern tier soybeans. And the vertical axis is the basis value, and the horizontal axis is time. And what this shows is that during harvest time, the basis has a tendency to be abnormally low or to be relatively low. Then the black line says that in theory, the basis increases over time at a rate equal to the reduced cost of storage as we get closer to the delivery option month. Now you'll notice here that this blue line is what I observe in reality in markets such as soybeans in the northern tier. What typically happens, you'll see it in graphs in a moment, is at harvest time, the basis falls abnormally large and we get extremely weak basis values. And then when that happens, then everybody starts storing, whether it be elevators, storers, processors, or farmers, they start storing and not selling. And then the basis has got to appreciate at an abnormal rapid rate relative to the cost of storage. And we see that all the time. This last year, we saw $1 a bushel increase in the basis from this point in time till the post-harvest period. The last point is during the delivery period, the basis has a tendency to equal what's called the delivery charge. In the case of soybeans, delivery occurs in licensed elevators in the area of Illinois and Missouri. So it's really out of our market area, and the delivery charges are typically about 2.5 or 3 cents per bushel, depending upon geography. So all that we can say is that at those locations, the basis will equal the delivery charge. Well, obviously in North Dakota and Minnesota, we're not at those locations. We're distantly located relative to that, so we don't really see this convergence in our markets like we do in the delivery market. So I'm going to show you some graphs and highlight a few points. And what I'm going to talk about is Jamestown, PNW, and Brazil. So here's the basis in Jamestown. I use Jamestown, I guess in part, this is a class exercise for my students. Jamestown is where Gavilan is. They hire a lot of our students. So ironically, we use Jamestown for that reason. And now Gavilan doesn't put their prices out publicly unless you log into their system. But this shows the history of the basis from 2010 until current, and the dark red is the long-term average. And I want to show you here, number one, there's a lot of variability in the basis. And you take a look at any one month. Take a look here in September. We see the basis as low as -160 to as high as about -50. So that's a huge range in the basis. That range in the basis is what we call basis risk. So this red line is the longer-term average. You can see the basis in July, August is at the seasonal lows. Then it increases very rapidly in the post-harvest period and peaks out in December, January, and then begins falling. Well, that exactly coincides with the end of the Brazilian marketing period. And then we have the post-harvest appreciation of the basis. And we peak out in about January, February, just at the commencement of the new crop Brazilian harvest. That puts downward pressure on our basis. Now, the most recent year is 2019-20, and you'll see here the basis was very low in March. It went up in August. Here was about -$1.20. I'll show you an update in just a moment on the next graph. On the right-hand side, I show the seasonal behavior of this basis. I'm real high on seasonal behavior of the basis for farmer marketing, and this is very, very clear in North Dakota soybeans, Minnesota soybeans, more than any other commodity that we do work with. We have seasonal lows of July, August. It increases very rapidly in the post-harvest period, peaks out in about December, and crashes following January. So here's the most recent basis. This is for Kensal, and I want to probably highlight a few points here. You can see typically the values are up here, back here in 2015 and 2016. When we went into the trade war, we fell down here to about $1.09 minus $1.80. So that was the effect of the trade war. We had a greater adverse impact on the bases in the northern tier states than any other state in the country. You can see the rapid appreciation following that, but you'll see here the seasonal low in September 2019 and how much it increased in that post-harvest period. And you can see that typically that occurs just about every year. During August, September, we get a sharp seasonal low and then a sharp post-harvest appreciation in that basis. And that's really important for you as marketers. And Frayne will talk about that more at the end of this. This is the current basis, and this is blowing up the same chart. But we can see here that the basis going into May and June increased pretty rapidly. And then it peaked out here at about the end of June. And then it fell off from that. And we use MACD a lot. Frayne will talk about those in technical charts. But this is very, very clear the basis was peaking out here at the end of June, and it's been declining since then. And actually, the current trend from a technical perspective is for negative movement in the basis. Here's Argyle, where Jim is from, and he'll speak to this later on. But you'll see typically the same behavior back in 14-15. We had relatively high bases. You can see here the effect of the trade war, and then you can see here the effect of the post-harvest 2019 appreciation, that basis. That basis increased 70 cents in 3 months following harvest in 2019. That is typically happens, and it's very important for you as farmer marketers. Your shorter term, they peaked out at the end of June, just like was the case of Jamestown, and since then the basis has been declining. So I think about 95% of our soybeans go to the Pacific Northwest, so whatever happens there is very critical to us. The Pacific Northwest basis is very statistically is very important in that it's impacted in part by the Brazilian export basis, in part by China imports. And this shows the same behavior. You can see the volatility. This particular crop year here, I can't see it because of my picture, my face in the way of it, but you can see the basis was very strong here at about plus $2 a bushel. More recent time periods, we're seeing bases more like around 50 cents a bushel. This red is the longer term average. So we experienced pretty high bases back in these years, 12, 13, 14. Since then, the basis has fallen to a much more moderate level. Longer term, you can see that this is the basis of the P&W, but you can see here on the right-hand side how the basis appreciated in recent weeks. Ironically, the basis of P&W peaked out briefly at the end of June, and then beginning the end of July started an upward appreciation. So we got the kind of interesting phenomenon where the P&W track basis is going up and our interior bases are going down. Maybe Jim can speak to that later on. So here shows a comparison of the bases at Jamestown in the lower part and the bases at P&W. You can see since the harvest time lows, the bases appreciated. And on this graph, which was prepared in early June, it was up at around $1. More recently, it's around $1.30. I'll elaborate on that in just a moment. Well, that basis, we're real big on measuring risk, and just for perspective on you, in today's market, the basis risk we measure as a standard deviation is 3 cents. The futures market risk is 8 cents. So today we have about 3 times as much risk in the futures market as the basis market. That's not always the case. Quite often the basis risk is as great as the futures price risk. And interestingly, the correlation between those are negative today, which has interesting implications for marketing. But on the right-hand side here, we show the standard deviation of a marketing strategy, whether you don't do any hedging at all versus hedging in futures or versus hedging in a basis contract. And you can see hedging in futures has the greatest risk reduction potential as you think about risk management. So freight, rail freight in particular, has a very important impact on the basis market. We study this to death. I'll just highlight a few points in today's current market. Our rail rates in the northern tier comprise of the tariff rates and what we call the car markets, both the secondary and primary market. And there used to be something called a fuel service charge, which does not apply today in the case of the Burlington Northern Railroad. So these are particularly important, and the effective increases in the secondary market value as the effective increase in the export basis of the P&W and decreasing the origin basis. Historically, on average, our statistical work says that an increase in the secondary market is about a 0.6% increase in the export basis and about a 0.4% decrease in the origin basis. This varies a lot over time, and it's probably not true today. But what's important about that secondary market, I'll show you charts in a moment, the factors that have a big impact then statistically in rank order is rail velocity, level of Chinese imports, and the Brazilian basis. So here's a secondary market. This goes from 2012 until currently. We keep track of this going back to 1988. You can see that this is extremely volatile. This is in dollars per car. We have many periods where it's very close to zero. In fact, today it's very close to zero. On average, over long term, it's about $220 a car. But you can see these spikes that occurred in 13, 14, where we went up to about $5,000 a car. In early 19, we had a spike up to about $4,000 a car. Nowadays, velocity on the rails are very good. Chinese demand is weak. Brazilian basis is weak, and the combination of all those means the secondary market values are relatively cheap. Here's today's secondary market. This is quoted through a brokerage company called Trade West, which is a cash brokerage company that trades commodities, grains, and soybeans, as well as freight. This is the market as of yesterday. So let me just interpret these to you. So in the nearby spot position, somebody's bidding to buy it at $400, somebody's offering at $500 a car. So a few weeks ago, that was close to zero. It spiked up recently, and I'm sure that's because of the recent Chinese Chinese purchases and other purchases of corn. But as we look forward, you can see it stays pretty flat at about $400 a car until we get out into September. It goes up to $500 a car. But you'll notice here there's a pretty wide gap between the bid and the offer. Historically, when we look at September forward, on average, that secondary car market value is about $800 a car. So we're still pretty weak compared to historical values. Here's the freight values looking at December and beyond. And you'll see there's not a lot of bids nor offers out there. So we really don't know what the market is looking that far forward, but it's probably moderating downwards. And there's no doubt in my mind that that is caused by the very strong nearby level of export shipments we're expected to accrue between now and November. As we look into February forward, probably an anticipated very, very weak demand, in part because of Brazilian harvest. And now a report just came out this morning suggested next year's crop in Brazil will be 6% higher. So this is incorrect. This should be Chinese imports. I'll make a few comments on that. I'm going to say it. I don't want to be redundant with what Frayne said yesterday, but as you know, China is the biggest importer off the West Coast. West Coast is our biggest market, so it has a huge impact on what we do here. In fact, statistically, it's level of Chinese imports is the second most important factor impacting that basis. If you want to say, why is the basis weak in recent years? Because of Chinese imports have been down. So here's Chinese imports. This is off Ag Census. The green this is by month. The green is Brazil. Blue is the United States. You can see down below here, this is total Chinese imports and that they've continued their escalation upwards. This is on a monthly basis, now pushing about 10 million tons a month. So their demand has been growing, but the amount of blue is the U.S. share, and it's been declining really since about 2018. So that's the Chinese imports. Just so you know how important China is, this is exports through May, the end of May of this year. You see China, these different bars show the different crop years. The purple one is the most recent crop year. But if you take away China, our next biggest market is Mexico, Egypt, Indonesia, Netherlands, and others. But the other countries, in the case of soybeans, are very, very small compared to China. So losing China is a big deal. It's even a bigger deal at P&W. This shows the same graph, but it's simply looking at P&W as soybeans. And again, if you take away China off the P&W, the amount of export market for soybeans is very, very, very negligible. And it's a huge challenge from a market development perspective for both North Dakota soybeans as well as USEC. This is China, our exports to China. This is through July. And you can see this black line is the current crop year that until early May were very nil, and we've been escalating. We've not reached our 2017 level. We're certainly behind those, but we're trending seasonally like we have in previous years. So one of the things I keep track of is Chinese purchases to date. So this is a very delicately prepared graph that I get from a friend of mine in China who, at the end of every month, they report how much they've purchased. So this is as of the end of June, and at the end of this week, I'll have the same numbers available. But this is pretty instructive for us. On the left-hand side, it shows their monthly demands. So their annual demand next year is expected at 94 million tons. And you can see most of their demand is in this time period of time, February into June. And this blue bar in the middle shows their purchases to date from September forward. So you can see they bought most of their coverage for September. And on this first purple column is how much they have left to buy. Now this doesn't count what they've bought during July. So what that says is they're about 83% covered for September, but they're very weakly covered in October, November, December. Look, the Chinese are very smart buyers. We teach them. They have a lot of experience. They are fully aware of the basis variability, the effect of the post-harvest basis in northern tier. There's no doubt in my mind they've been holding off on buying OND until we get closer into harvest when they see seasonal lows of that basis. And then I'm fully expecting they will accelerate their purchases to get filled for those months forward. And take a look, they're already buying in March of 21. So they're looking beyond northern tier harvest and buying pretty extensively in March of 21. And as you look into March of 21, they're about 50% covered for that time period. So I'm guessing they're holding off very strategically to take advantage of the cheap bases as we get into our harvest period. So taken together for the coming crop year, they're about 27% covered, so they have quite a bit left to buy, mostly in OND. And at the end of June, July, August, that would be the end of the Brazilian harvest period. And at that time, they'll be looking at how big is the crop in Brazil, how far forward into June, July, and August can Brazil be shipping relative to northern tier grains. We're studying this pretty extensively on some of our research, and this is a graphic showing the market share by month of the different origins. And a few highlights I want to point to you is this goes back to 2012 until current. So the gray line is the Brazilian market share. Number one, you can see those market shares are highly seasonal. Brazil peaks out, you can't see the months, but Brazil peaks out in market share in March through about June, and then they fall off. The blue line is exports from the US Gulf, the orange is the exports from the Pacific Northwest. You can see here the impact of the trade war commencing here in 2018, and that instead of the US Gulf getting about 80% of the market, they started going down to about 50% of the market, and eventually down to 20 or 30% of the market. And the PNW, instead of getting 30 or 40% of the market, we're getting about 10% of the market. Now this is changing as we go into the more recent weeks, but you'll see here that this Brazilian behavior is changing pretty sharply, and we call that the trade war effect. Well, we're studying the logic behind this and the logistical challenges that facilitates that. So there's a lot of, I'm only going to give you 2 slides on this issue of phase 1. Frayne spoke on it very eloquently yesterday. These are 2 charts I want to show you that were put out on Thomson Reuters yesterday and today. And it shows on the top left, Chinese soybean imports from non-US suppliers. Red is 2020. So seasonally, you can see that they're very strong for non-US suppliers. And the lower part is their imports from the United States. So seasonally red, they've been very low amount of purchases from the United States. Okay, now here's a graph that Thomson Reuters put out this morning. And this is the value of farm goods, because Frayne talked about the trade deal and everyone's trying to guess, are they going to meet their requirements or not? And of course, nobody knows, except the Chinese, I guess. But this is the graph, and I'll show you the comment from ADM as of this morning. And this shows the value of farm good imports through April and May. And you can see they're probably low, but normally they accelerate their purchases in this period of time, September through December, which is primarily soybeans. So through January, May of 19 and 20, they've been buying in there about $7 billion, but their goal is ultimately achieve 36.5. Now, Frayne qualified that a bit yesterday. This is a number Reuters is using, 36.5, which would lead one to conclude they got a long ways to go to meet this objective. Down below here, I quote what was in ADM's market letter to Steve Freed this morning, and he just goes on, I won't read it to you, but he says, with 7 months to go and a target of $36.5 billion, they're less than 50% of the way. And he was suggesting they would probably not be making it, considering the rapid deterioration of US-China relations, the upcoming US election, global pandemic, and everything else. The most important, and Frayne didn't mention these yesterday, this is a 2-year agreement, not a 1-year agreement. There's a term also in the trade agreement that China has to buy that amount at market prices. So long as the US is competitive relative to the market, then they should be buying that amount. Now, in the case of soybeans, until recently, the US has not been at market competitive prices. Now, in reality, there's going to be a big fight over this issue, I'm anticipating. USDA has discussed this with me. I wanted them to give us some money to study this and put a parameter around it. And my conclusion is they don't dare study it. So we'll see what happens. The second thing about these agreements is a reminder. Remember, if the logic of the agreement was in 2017, Trump said, we don't like your state-owned enterprises and your intellectual property protection, and you're stealing our intellectual property, and we're going to impose tariffs on your imports to the United States. In March of 18, China said, if you impose tariffs on our exports to the United States, we're going to target U.S. soybeans, and we're going to put in place a 25% tariff. They went into effect July 1st. And all the time, the logic of the Trump administration was, we will separate this to phase 1 and phase 2 issues. We'll negotiate phase 1 that will set the stage for phase 2. Phase 2 is said to deal with intellectual property and state-owned enterprises. But phase 2 is contingent upon a successful phase 1. Everything I read today on the US administration, they have no interest in pursuing phase 2. So we'll see what happens. I can't guess. We can talk about it later if you like. So let's talk about Brazil. Just briefly, Brazil's had substantially improved logistics in their market system. I'll highlight that in just a moment. As they look forward, they expect acres to go up 3% this coming year, 6% increase in production. News story out this morning. And with the implication of this is that Brazil, they used to be able to only export 5 million tons a month. Now their export capacity is about 11 million tons a month. And with the increased production, that means they can be competitive into June, July, August, whereas before they were only competitive into April, May. So one of the key parameters there is waiting times at port. And we're studying this a lot right now. And back in 2013, the average waiting time for a vessel in port was 15 to 20 days. Now, $10,000 or $20,000 a day for 15 or 20 days, that's a lot of money. But you'll see how, on average, that's declined now to less than 4. So that's as a result of lots of cumulative investments in the logistical system, which has a big impact on ultimately our basis values. So here's the Brazilian basis, the red line. This is seasonal averages. On the right-hand side, you'll see their basis is abnormally cheap in February through May, June, July, and then peaks out in August, September, just opposite of when ours peak out. This shows the seasonal variability across different market years. The most recent market year, this is this purple line here at the bottom, and you'll see the basis getting lower and lower. That's partly because of their improved logistical situation. This is a chart I think Frayne showed yesterday. We get it off AgriSenses. The green line here is the basis at Brazil. And you can see back over time, this is the effect of the trade war where Brazilian bases went sky high and bases in the US Gulf and PNW went to very low levels. Since then, they've been moderating through July, August. More recently, the Brazilian basis has escalated to be a premium relative to the PNW basis and the US Gulf basis. So, the problem with information is once you start getting information, you never get enough. One of the sources of information I keep track of is McDonald Pelz. They're an international cash grain broker. Technically, they're called a price assessment company. And they put out a newsletter every day that looks like this, which shows the basis. And this is FOB basis. And to my knowledge, it's one of the only sources other than AgriSenses that reports FOB basis. So take a look here at September. They're showing a FOB basis PNW for September 150 and pretty flat going out at 150 all the way into February and then going down. But I want to point out, I put down on the lower chart right here, and Jim might speak to this, the track basis at PNW today is about 120 or 130, and the FOB basis is 150. So that means an implied margin of 20 cents, which is pretty high. Don't tell anyone I said this, but it's probably pretty high. But take a look at this Brazilian basis. Going forward, they list them at about 160 in the nearby months, but when they get out to February, going to 89. So that's a 90-cent decrease in the basis in Brazil between now and February. Well, February is the beginning of a new crop. And so that has very important implications for you as marketers. This is a plot of the forward curve of the Brazilian basis. This is PNW blue. The yellow one is US Gulf. This is the basis at today for Brazil, going out here, peaking out in January and then falling. And you can see how sharply it's falling out to 9 months forward. That is really important for you because the decline in the bases in those out months in Brazil has the effect of lowering the bases in the US, which ultimately lowers the bases in the interior of the United States. We spent a lot of time studying the bases. I'm going to skip this, but these are studies we do for the Soybean Council. I'll share it with any of you want. But of interest in here is we do some very elaborate time series modeling. In the period of time prior to the trade war, these arrows here shows the interdependencies between basis values in the interior United States, Pacific Northwest, US Gulf, and Santos. Santos is in Brazil. You see they're highly, highly interdependent, meaning everybody affects everybody, strongly or weakly. In the post-trade war period, this is the causal relationship. It's US interior basis values directly affecting the Santos basis, bypassing our export basis. We haven't figured out the reason for that yet, but it's pretty significant. I want to make a few comments, spatial competition, and then I'll draw a closure. So firstly, we have to talk about PNW versus going to the US Gulf. The most efficient logistical channel going to the US Gulf is through St. Louis. So you go shuttle trains to PNW or shuttle trains to St. Louis. This comes up all the time when people start saying, well, look for other markets other than PNW. That's not so practical, and I'll show you the reason why. These are basis values that actually Jim shares with me every day, and you can see the delivered price at St. Louis and the delivered price at PNW. So if you translate all of that for an elevator in the Jamestown region, here's the freight values going to St. Louis and PNW. And these are the net prices at Jamestown. And these are the current Jamestown bids. So a Jamestown merchant would be looking at about a 26-cent greater margin going to PNW than St. Louis, and a 50-cent in new crop. So PNW dominates this market by about 25 to 50 cents, always. I haven't been studying this forever, but I've been including it in my lectures since 2016. Sometimes we get within 3 or 5 cents of each other, but typically they're 20 to 30 cents. Here we're 50 cents difference in new crop. And all that says is PNW is really important. And unless something very, very, very radically changes, PNW will always dominate this market. Now, an international arbitrage, this is important because it shows the competitiveness of the US Gulf, PNW, and Brazil. These in the upper graph here is in the spot months. So these are FOB port values, ocean shipping costs going to Asia. And down below is the total cost delivered to Asia. And you can see today PNW is the lowest cost origin. Until recent weeks, that has not been the case, okay? Now, if we look forward into the period of time through February of 21, down below here is the same calculation, and it shows here that PNW has an advantage of $2 or $1 a ton until we get into January, February. That's about 5 or 6 cents a bushel. Not very much. That's a pretty tight, highly competitive market. So the PNW dominates the market. I know Frayne said yesterday we should be seeing more shifts to the PNW, but the predominant imports have been, or sales have been made in recent weeks are all via the US Gulf. And hidden behind the scenes here, I believe, is a perceived quality differential, real or not, at the PNW relative to the US Gulf and relative to Brazil, where the grain traders typically want to be taking a discount or given a discount of 10 to 20 cents a bushel at the PNW. That's something we're working on, and the North Dakota Soy is working on as well. So at the moment, we're pretty competitive. If you want to see how that looked, back in April, the last time I spoke on this, Brazil had advantages going through those same periods out in August of about $3 to $6 a ton. All right, so probably I'm going to begin drawing closures, but people always ask me, how should I analyze the basis? And here's what I tell my students. Number one, just be fully aware of inversions in the market. you don't have to analyze too much, but in today's world, we're on the fringes of an inversion in the futures market, an inversion in the basis market, and an inversion in the freight market. All of that says there's a premium for nearby relative to deferred. So that's the first point of analysis. Second one is a seasonal behavior, and the third one, here's how we analyze seasonal behavior. We're pretty high on moving averages. Frayne talks about technical charts all the time in futures. You can apply the same tools of technical charts to the bases, and we do it automatically on DTN Profit X. We do it automatically on my DTN, and I think most of the tools are out there now to apply those charts. This is the Jamestown area basis right now, as of today. Up above here is the basis value. Down below here, we apply MACD. And this shows that we had an appreciating basis from the end of May till the end of June. And since then, we've been a declining basis. I'm guessing that we're on the fringes of gravitating towards the seasonal low basis during August and September. That'd be my guess right now. And then we spend a lot of time on seasonal indexes, and we study these, but here's what the results show. This shows the average basis in North Dakota, this red line. You can see here it peaks here in December, January. So Frayne should tell you, and I think he does, is that if you're planning your market strategy, plan to sell everything in December and January for delivery in those periods, depending on your tax situation, because in the period of time after January, there's a very high probability we're going to see seasonal declines in the basis of 30 to 50 cents a bushel, and going into July, August, a much larger reduction. That's harvest pressure in the United States. So when we derive these as indexes, that's what's shown down below here. Those are the seasonal indexes. It says that in August, on average, the seasonal basis is 61% of that crop year average. And then it reaches a peak of 120% in December. So that means that the basis is going to virtually double on average between August and December. That's not going to happen every crop year, but it happens every year with that appreciation. This is a chart I use in my class, and now Brock is putting it out, and I don't think I copied it from them, but nevertheless, they show historically, this is Central Illinois, when is the likelihood of the lowest basis, and they said 28% probability in August and 30% probability in October. So just as I look forward in 2020, not 2002, in the old crop, everything is being dominated by the China trade representation of phase one, the end of Brazilian harvest and the lower bases there. The normal seasonal declines into February to July, and now we have inversions across all of our core markets. Looking at current new crop, we have favorable growing conditions. Frayne spoke on yesterday. We have outstanding or anticipated additional Chinese purchases, as I showed you, probably for the period of time October through December, though they're going to have a delicate balance on the freight issue. Our freight values are increasing from October into December. We're probably going to have seasonal lows in October, August, September. So when I teach it, I always say, well, harvest time lows, and then someone said, well, when is harvest time? Well, I studied this at one time a number of years ago, and the seasonal low occurs most likely when we're 60% done harvested. So keep track of our harvest progress. It's not a very good statistical relationship, but it's the best number that I can give you. Very high likelihood we'll have seasonal peaks in December, January, which should spell out your market strategy. And the last point is, in concept, what goes on in these markets is we have an inversion now. We're going to have harvest. Farmers will accelerate their selling. The effect of that will lower the spot nearby bases. Storage becomes attractive, so people begin storing at elevators, processing plants, and at farms. That will force the nearby bases down, which will have the effect of widening the intermonth spreads in order to induce storage into the period of time January, February. So with that, I close. I'm sorry I didn't stop for a break, but I'll maybe take a few moments of questions now at this moment, and certainly try to elaborate on any of the points you make. And actually, as you think of your question, I'm going to get a quick drink of water, Jenna, and then I'll come back and take questions, and then we'll take a break, okay?
That sounds good. So if you have any questions for Dr. Wilson, go ahead and get those. I see one, I've got one coming through in chat here. You can use chat, the Q&A function as well. And we'll line those up for when Bill returns.
Is there any questions, Jenna?
My computer's being slow. Okay, we've got one question here, Bill. It says it's coming from Barnes County. Basis improved 65 cents for new crop delivery. Do you think this will get better, or should they grab it and maximize harvest delivery at this basis level?
Good question. I'll give you a very solid answer on that. There's a strong, I mean, we've seen a pretty sharp appreciation in the basis since the end of May. And it seems as though it's been peaking out towards the end of early July. And there's a very strong seasonal tendency for the basis to crash. And I want to emphasize the word crash, meaning falling 30 to 40 cents as we go into August and September. So if I had old crop, I would certainly not be storing it into a declining basis period. So I'd be grabbing it, using the words of the questioner, I'd be grabbing the high basis for old crop now because of the anticipated sharp decline in basis August, September. The only thing that would change that if all of a sudden China comes in with massive purchases for very, very, very nearby shipping periods. That would surprise me. So that's my answer.
All right, I got another one here. Can you lock in your basis without selling the commodities at the same time?
Yes, but I want to draw, I suppose this depends on the contract term, and I would urge you to ask Jim when he speaks as well. We talk all the time about basis contracts, so that provides a mechanism to lock in the basis. But if I understand it correctly, when you lock in the basis, you're selling the commodity with a fixed basis. So maybe to parse that question, you're locking in the basis, you're selling the commodity with a fixed basis, but you're not fixing the futures component to a later point in time. So technically you're selling the commodity, but all you've done is fix the basis component.
All right, another one. Are you concerned about oil traffic on rail because of DAPL going forward? Will that affect P&W bids?
Yeah, so I'm not intimately involved in this. I would be not so concerned for a couple of reasons. Number one, in contrast to 1314, the railroads have a tremendous, well, first of all, in DAPL, that may or may not be forced onto rail, that's yet to be determined. But that aside, the railroads have indicated that it will take them an extended time period to ramp up their capacity to begin moving oil. And even though a friend of mine is the head of the oil traffic now on the railroad, I'd be curious his thought process, because all this being haggled over in DAPL is whether or not they freeze shipments on the pipeline for 12 months. Well, if it takes you 10 months to ramp up capacity, I would be surprised if the railroads would ramp up a huge amount of capacity with the expectation that DAPL would be approved following 12 months. And then the third point is that the railroads have a tremendous amount of grain capacity sitting idle. And I don't know the number exactly, but I was told it's in the area of 30% of covered hopper cars and locomotives. And so the ability to expand rail capacity for grain is pretty substantial. So I'm not so worried about it today because the conditions are much different than 13, 14.
And then any significant shifts that you see in wheat or corn basis coming up?
So I just had not, I've followed them. I've not updated my work so much compared to what I've done at soybeans. So it's probably better I don't speak to that. But when Frayne comes back, I think, Jenna, you could ask him that question as well.
Okay. So let me read through this one. So it says, it seems that there should be a market opportunity with the Chinese trying to obtain phase 1 commitments, but risk with the increased trade tensions between the US and China. So as a producer, given that you've got this market opportunity, but this huge amount of risk, what do you suggest that producers make of that, and what do they do going forward?
Well, so you're partly asking a question about what are the Chinese going to do. So I'll just give you my opinion on this, and it's not a result of any analysis or anything. I suspect the Chinese will be accelerating their purchases very strategically. They'll be accelerating it through the October, November, December period. They want to probably represent going into the election that they're a good faith partner in the phase 1 trade agreement. Whether or not they fulfill their terms or not will be beyond November, so it probably doesn't matter. But they would be wanting to be representing that they're a good phase 1 partner. Now, I'm guessing also the people involved in buying at China are pretty smart, and they know every chart that I showed you. They are fully aware of the fact that the basis falls in the northern tier in the P&W in August through about October. And they have a large amount to be buying for October, November, December. So I'm guessing they will be buying more for that time period from North America. Whether it comes from the US Gulf or the P&W is yet to be determined. We would think on paper it would come from the P&W, but that may not necessarily be the case because of all of the other things that influence their purchase decisions. I don't fully expect they will meet their phase 1 part of the agreement, but they'll give the impression they're trying to accomplish that. So back to what would I do as a producer? I think the tea leaves for you as producers are what are the spreads in the futures, what's the spread in the basis market? And currently today, those markets are very efficient. They all spell sell in the nearby. Sell in the nearby, store through the harvest period, and be sure you sell by December. That's what the tea leaves say.
Thank you. Any other questions for Dr. Wilson? I think he'll be hanging around.
I will be here later as well when there's questions, and maybe Jenny, you give a 3-minute break and then introduce Jim.
Yeah, let's do that. So it's 9 o'clock. Let's meet back here just to make an even time at 9:05. And we will get Jim Fagerholt. I'll quick introduce him here. Jim is the general manager at Marquette County Grain. We've asked him to speak because of his excellence in his field, but also because he's a big supporter of the NDSU commodity trading room. He's also a big supporter of the Ag Econ program at NDSU. So we're looking forward to hearing from him at 9:05 when we return. All right, it is 9:07, so I'm a little bit behind when I said we would start. So we'll get going. So we've got Jim Fagerholt here from Market County Grain. I introduced Jim just briefly. So Jim, I'm going to send it over to you for your industry outlook of the upcoming market. If you want to give just a brief introduction of yourself, that would be great. So with that, I'm going to unmute you here. And then should be able to share screen and we will get going.
Good, thank you. Let me pull this up. Make sure I share the right screen. Okay. Yeah, hello everybody. Yeah, my name is Jim Fagerholt. I am the general manager at Market County Grain in Argyle. We're a regional grain company. We've got a shuttle loader in Argyle, Minnesota, one on the CP in Alvarado, and we are half owner of Ace Valley Grain in Barnesville, Minnesota. So we kind of run up and down the Red River Valley here on the east, on the Minnesota side. Frayne and Bill asked me to speak a little bit about soybeans and specifically regionally how soybeans trade, the impact of rail, local economics. So I'm not going to dive real deep into macroeconomics or even global soybean trade or even soybean ending stocks, but I'll get going here. So just to kind of touch on a few items, current grain market factors right now, we've got U.S. corn supply most likely peaking in 2021. We're going to have a record crop this year, record ending stocks. It looks to me like we're going to have very large yields across the U.S. We've had pretty favorable weather conditions. World wheat supply is record large right now. World soybean supply is lower for the second straight year. We've cut our U.S. ending stocks in half in 2 years. Like I said, we've seen favorable weather for strong yields on average. I know there's pockets everywhere that are seeing issues, but in general across the U.S. we've got favorable weather. We've got a weaker U.S. dollar recently, and lower futures prices, and stronger than average basis levels. So those are just the over-encompassing themes right now. Okay. So U.S. soybean supply and demand. I'm not even going to share an ending stocks chart with you. Like I said, we've cut our ending stocks in half. We've come down to the 450 million bushel area, which kind of brings us closer to the average level. I wouldn't say it's overly bullish, but it's not bearish. Things have been picking up. Things are looking positive. You can look at this chart here. We got U.S. monthly soybean exports out of all ports. The top blue line is the 4-year maximum. The bottom line is the 4-year minimum, and the average is the gray line. In 2019, 2020, we've been below the average. So the trade deals are just really getting going and coming to fruition. We've been seeing below average exports to China, but now we're working our way through that. If you look at, so this isn't super easy to see, this is U.S. next year marketing sales. So this is sales right now that are a year away still. If you look at the 5-year average, generally in this time, we've got roughly that 250 million bushels out of here for a year away. Last year, we only had 100 million bushels sold. This year, as of today, we already have 400 million bushels sold for next year. So we are well ahead of a normal 5-year average, and drastically higher than last year at this time for export sales for the following year. This chart shows some of the same data. The 2019-2020 crop, as you can see, we're going to be somewhere in the 600 area to China, and so far for next year we already have 262 million bushels. Those numbers are climbing right now. Every day we're finding new sales. So things in general are looking optimistic compared to last year. But as you can see, we're nowhere near 2015, 16, 2016, 2017 levels. So we've got a lot of business to do to start getting back to the levels that we were then. And it's going to be very tough with competition from South America, that they continue to be the provider of choice for soybeans. But there's some impacts that might help us along the way here with that. One of them being the US dollar. So just recently, we've seen the US dollar come off its highs. As you can see, we've found support for the US dollar on this trend line that started in 2011. So this is a long-term chart, but if the US dollar continues to fade from its highs, that's only good for US commodities, whether it's wheat, corn, or beans. When you compare this specifically to the US dollar versus the Brazilian real, we've seen this price relationship really go in our direction here recently. The March highs, where the US dollar was priced considerably higher than the Brazilian real, has changed pretty drastically since March. So we're getting back to levels that we were at the beginning of March, before we had this big rally in the US dollar. I'm going to come back to how those impact you as a grower and what you do with your soybeans, but I want to just discuss the PNW trade area a little bit here. So this map here shows the U.S. soybean crushing industry. This is basically all major plants. I know you don't see Enderlin on there, but Enderlin is kind of a switch plant that it's not considered a major plant. What you'll notice is they don't even have North Dakota on the map, or northern Minnesota. That's obviously for a reason. We don't have any major crush plants. There's speculation that that's going to change in the future, that there's a plant going somewhere in central North Dakota. I don't know if that's true or not. We'll see. But as of today, we don't have any major crushing plants really anywhere near us. What that means is our soybeans, for the most part, have to leave on rail. This map here shows the PNW draw area, for the most part, in the yellow shaded area. You can see you've got North Dakota, South Dakota, Nebraska, and Minnesota are the predominant players for the PNW. You get Western Iowa, some. Northern Kansas is a player, some. But you can start seeing the freight spreads. So if you look at the numbers in red, you can see that there's negatives in North Dakota and there's positives when you get down to southern South Dakota and into Kansas. That's a freight spread to the PNW. So basically, the 10 cent is the Highway 2 corridor and north, where it's cheaper to go to the PNW than it is to the Gulf. And when you get down to northern Kansas, it's 35 cents cheaper to go to the Gulf than it is to the PNW. So a grower in Kansas has a 45 cent disadvantage over a grower in northern North Dakota as it relates to the PNW. And obviously they've got an advantage being closer to the Gulf. But the advantage you see here is that the PNW in general does have a freight advantage. When going to China, the PNW has about a 55-cent cheaper rate to China than the U.S. Gulf does. So that's why we see the majority of trade to China go out of the PNW. We also have a transit time of 20 days out of the PNW to China and 30 days out of the Gulf. When you compare that to Brazil, Brazil has a 32-day transit. Now, there's times when you've got a Chinese processing market that is absorbing a lot of beans, that a 12-day difference in transit time is the world to them. So there's a couple different advantages they've got. I wanted to cover acres coming up here. So this is the PNW dry area again. This is 2020 versus 2019 soybean acreage. As you can see, North Dakota is 400,000 acres higher. South Dakota is 1.7 million. That's a little bit skewed, obviously. South Dakota had a rough year a year ago with a lot of unplanted acres. Minnesota, 550,000 acres higher. So in general, we've seen a big increase in soybean acres this year across the PNW trade area. So although North Dakota's got, on the next slide here, you can see a big decrease in corn acreage because of PP. Soybean planted acres are up. Shouldn't be a major issue for the PNW to be able to supply soybeans out of the PNW dry area. Wheat acres are down. Again, there's some PP issues, especially in North Dakota. 2020 versus 2019, you've got 675,000 acres less. So, what does that mean for the PNW dry area? Well, when you look at an increase in bean acreage and a decrease in corn acreage and a decrease in wheat acreage, what that means is the grower in general is going to have soybeans to sell, but probably will also have the bin space to be able to store those beans and not have to ship those beans into the market at harvest, which becomes a pretty important factor going forward here that I'll discuss. But I don't want people to get too excited that your beans are worth gold if you put them in the bin. That's typically not the case. So some negative factors that we need to really consider so we don't get too bullish on soybeans here. I don't know how easy this is to see for you guys, but you've got soybean good to excellent versus average. Just in general, this soybean crop looks really good. On the top right there, you can see the 2019 crop in blue is the good to excellent, below 60%. The average is in week 30 to week 35 is to go from 60 to 55. Right now, week 30, we're in that 72% range, good to excellent. So we are well above the average percentage of the crop that's in good to excellent condition, which is not a 100% guarantee we have a big crop, but it's looking very likely that you're going to see pretty big yields across the U.S. on soybeans. Corn looks pretty similar. The corn crop looks really good. So, USDA has their forecasts for soybeans and corn yields. If we came in higher than those yields, the trendline yields, I would not be surprised at all. I mean, we might at some point be talking about 180 bushel corn yield. So those are a couple things we need to be considering, that even though the PNW has a big program for soybeans, they're looking for more. There's going to be plenty of beans in the U.S. for sale. So there's always somebody that's going to be willing to sell them. So keep this in mind. One thing to talk about when looking at how world exports affect you as a grower in North Dakota is when the world needs our beans. And without getting too detailed, you can look and see here that the U.S. has this blue line, and this is in 1,000 metric tons. So basically you can see the blue line peaks for shipments out of the US to different countries in October, November, right? That's a lot of harvest. That's when we see our biggest soybean export programs. At the same time, you're seeing South America not at a low, but at far below their peak, which is in April and May. So you've got the U.S. supplying the bulk of world exports in October, November, and December, and then you've got the U.S. doing very little business April, May, June, starting to rally to rise a little bit in July, August, but still very low as a percentage basis. We do very little business. We do very little world business in April, May, and June, and South America does the bulk of it. So, the thing to remember is, in general, the world does not need our soybeans after October, November, December. They just generally don't need them. South Americans are, for the most part, willing to sell soybeans cheaper than we are, especially when it comes to March, April, May, and June. They've got their big supply. That's where China's going to source their beans from, for the most part. So our big demand area is at harvest. One big impact, and this is a pretty simple slide, but I want to make it very easy to see here. If you look a year ago, October rail car values, 1 year ago today, you could buy October cars at $0 a car. So this means that the BN's got their tariff rate, which is set. They did not change it this year, so it's the same as last year. But this is what we have to pay above and beyond that tariff rate to get cars placed at our facility so we can load them. Today, to buy October rail cars for 2020 is $900 a car. That is going higher every single day. We are probably, I would guess, October cars could trade at $1,000 this week or next week. You're talking 24, 25 cents a bushel. So if you look at a P&W bid a year ago, we were at 75 over, delivered to the P&W, $0 per car on car values. P&W bid today is $1.33 over, with $900 a car is 24 cents a bushel. The net effect on the basis is 34 cents better than a year ago. Now, if you look at our basis levels are actually better than 34 cents. Now, what happens is when you see a $900 over car trade, you're going to get companies that some have bought cars cheaper, some simply ignore recognizing what cars actually cost and just absorb the costs. For the most part, it becomes a pretty competitive landscape because you've got people not recognizing what car values actually are. And when you've got North Dakota that's got an ample bin space this year because of the lack of corn acres, you've got commercial grain companies that are looking at bunkers. They're going to go empty if they don't get enough beans off the combine. So what happens is you've got elevators right now that are essentially giving away the carry. They're saying, I got 2 bunkers here. There's all this stuff's going to go in the bin on the farm. I'm basically going to I'm going to bid economics for a month or two down the road, and I'm willing to basically give up to carry because otherwise I won't get the grain. So the actual effect on basis is 47 cents better than it was a year ago. A year ago today, we were at $1.15 under November futures. We're at 6,800 right now. Like I said, I'm not going to dive really deep into ending stocks or the intricacies of world soybean trade. I'm trying to speak at a local level here to help growers like you figure out what to do this year and in the future. This chart here shows corn, soybeans, and spring local basis. So the spring wheat, this is Mark Honey Grains spring wheat basis over the last 5 years. So it's an average of twice a month over the last 5 years. As you can see, so spring wheat basis is in the blue, corn is in the red line, and soybeans are the green line. What this chart shows, and I probably should have put this on a September 1st at the beginning on the left side of the chart, but it's not. It's for the calendar year. If you look at the harvest, so you've got spring wheat basis that our average basis over the last 5 years at the gut slaughter harvest is about 72 under. Corn for harvest is 75 to 80 under, and beans on average have been $1.15 under at harvest. So you've got 5-year averages that are basically spring wheat is about $1.15 to 72. You got 28 and you got 43-cent better basis on spring wheat, but that's kind of irrelevant when we look at what you do from harvest. What do you deliver at harvest versus what are you going to carry in the bin? And that's what I really want to speak to you today about is what pays most to put in the bin and what you should be delivering at harvest. So that's a 5-year average. Let's take a look at what beans look like. This drills down to soybean harvest basis over the last 5 years. You can see that we've been in a range from as low as in 2018, we got to $1.65 a bushel, $1.65 under, excuse me, to today, we're at 68 under delivered at harvest. You can see that in the last 5 years, and this is actually the last 10 years, I've been here for 11 years, we are at the best basis levels I've ever seen for harvest delivery soybeans. Average basis, like I said, is about $1.10 to $1.15 on harvest delivery beans. So as a producer, your decision becomes, what do I do today with soybeans? I've got beans in the field, I've got corn in the field, most of you probably have wheat in the field as well. What do I do with all this? Do I store the beans? Do I store the wheat? Do I store the corn? From my perspective, that becomes a pretty simple answer. And this year, you can look at this chart, and I can tell you simply that if you've got limited bin space and you can't store all 3 crops, your decision easily should be to haul the soybeans in at harvest and use your bin space for corn and wheat. And I'll dive into that a little more in a few slides from now, but I want to get over a couple of things here first. When figuring out how to capture the best prices on soybeans, I know Frayne's kind of probably covered some of this stuff here, but I'm going to give you my approach. These are November futures contracts for soybeans, the high and low every year for the last 5 years. As you can see, we've had some pretty good opportunities. And just to be perfectly blunt, one of the things that I hear from a lot of growers is that there's never any opportunities, that we can never sell a profitable level. And quite simply, that's not true. The problem with that is it's the approach. So if I have a farmer that says, when I harvest my beans and I put them in the bin, there's never an opportunity to sell at a profitable price, that's correct. It's pretty correct. But when the farmer says, I can never sell soybeans at a profitable price, it's incorrect. And the reason is the approach. The approach for most growers is to harvest the grain, put it in the bin, and then let's figure it out later. Let's hope for a rally. I know some people do forward contracting, but generally not enough. Generally not going far enough out. The reason that you look at this chart today, and a lot of you probably don't remember these prices, and I forget them sometimes too, is that generally these highest prices that you saw didn't come after you put these beans in the bin. They came 12, 24 months ahead of time before you even harvested the crop. There's years when that doesn't happen. There's 1 year out of 10, you might do nothing and you might get rewarded for it. And you sell your whole crop the July after you harvest, and that's your best year ever. That's going to happen in 1 out of 10 years, maybe 1 out of 20 years where it actually works. this is a seasonal chart of November beans. Beans, I'll admit, don't have as seasonal a tendency as corn and wheat do. I'm going to show you the corn and wheat charts next year. But this is over the last 10 years. As you can see, this chart, this is a pretty long chart. This basically covers about 2.5 years. Soybean and corn contracts generally start trading 2 years to 30 months ahead of when you're harvesting. There's a long window. Wheat does not give you that luxury. September wheat contracts generally give you about 14 months ahead of harvest when they start trading. But soybeans and corn give you a long time frame to sell your crop. So as you can see here, like I said, there's not as much of a seasonal tendency for soybean prices to decline into harvest. But look at corn. This is 2015, 2020. December corn chart, the December corn contract, when it opens, on average has opened at $4.45. This is literally 2.5 years out. So this is a long time frame, but when the contract starts trading, on average it's opened at $4.45. On average, it has expired at $3.55. So on average, you see a 90-cent decline from open to close on the contract. Spring wheat. On average, the contract has opened at $6.43 and peaked about a month later at $6.55 and sees a low the following May at $6 for a 55-cent decline. On average, it opens at like I said, $6.43 and closes at $6.12. So a 31-cent decline. Generally, in Minneapolis, you see the market is willing to pay 4 to 5 cents a month in carry. When you've got commodities that have high ending stocks, typically like corn and wheat, there's always a supply. There's usually always a carry in the market. Soybeans are a little more volatile. There's times when we see big changes in supply, and generally soybeans don't give you the carry that wheat and corn do, which becomes an important factor in decision making when you look at what you're going to put in your bin. But in general, as you can see, when the contract opens, let's look at that peak in June at $6.55 to the low in May of $6. That's 55 cents. Over 12 months, that contract was basically a nickel a month that it lost in value. One major principle that we really try to preach to our growers is what carry means and how you actually get it, and what I call the fair value factor. Generally, you've got end users that have what they consider fair value, okay? And unless something in the supply and demand changes or something economically changes, they kind of like to have a set price where they say, you know what, I'm willing to pay X for wheat this year. And I'm going to use wheat as an example. The mills generally are saying that they believe that front month futures on wheat should be $5.25. What happens is when you're in a carry market, if fair value is $5.25 futures and the front month expires, and it's at a carry, let's say it's a 15-cent carry, so you've got front month at $5.25, you have the next month at $5.40. 9 times out of 10, what happens is the front month expires, goes off the board. The next month it takes over as the front month, now gravitates down towards fair value. That's a big principle to understand, that when you're trying to capture carry, you don't get it unless you use time as your friend. A lot of times what we see, unfortunately, is using time as your enemy. And the way you do that, using time as your enemy, is doing basis contracts. It's doing nothing, hauling in on a basis contract, and then rolling your contract. You haul in at 45 under, there's no pricing opportunity. Then you roll for the next month at 10 cents. Now you're 55 under. then you do it again, and now you're at 65 under, and you keep rolling. When you're doing that, you're not only not using your bins in the right way, you're actually paying somebody else to for the bins that you built. There's a better way to do that. I know I'm kind of getting off the soybean track here, but I feel it's important to really look at soybeans, wheat, and corn as you're looking at a marketing plan to figure out what to do here. So, like I said, you do a basis contract and you continue to roll, and you see your basis erode. What you're doing is, and instead of gaining the carry in the market, you're locking in basis and then watching this futures market decline as it trades towards fair value as each month goes off the board. So your basis gets worse. The futures month you're attached to gravitates towards fair value, and in the end, it becomes hard to get a profitable price. So one thing you can look at here is, this is a November 20 soybean chart, futures chart. I apologize, the numbers aren't really easy to see on the right side. What you can see is we had a peak in the market in March of last year, and then again in November and January. November 20 beans peaked at about 980, 981. We got to that level basically 3 times over the life of this contract. If you look at, I've kind of split these up into zones here, and the zone on the bottom that's in a red channel is an area where if you lock in futures at those levels with a normal basis level, it's a losing proposition, meaning your cash price is low enough, you're not hitting your break even. The area in the middle where it's 910 and 930 futures is your break even zone. Then you've got 2 sell zones here, one from the 930 to 950 area, and one basically 950 and above. Those are actually areas where you can sell profitably. And in the green text, you can see the first peak in the market was 18 months prior to harvest. The second 2 peaks were 12 months and 10 months. Now, I'm not saying that we won't get back to these levels again before harvest, before this contract expires, but I would bet a lot of money we don't get past the break-even zone. Right now we're at I updated my futures today, but this is as of yesterday, 893 on no beans. If we get into the 910 to 930 area, which is an area you can break even at, that might be as good as it gets. Now keep in mind, if we get to 910 to 930, you're able to lock in a better than average basis this year, which means your cash price might get to a price where you're probably profitable because you're locking in futures at a break-even zone and you're locking in basis better than average. So keep that in mind, that the highs you saw, the 980 highs, I don't think we're going to get there again before harvest. In order to get there, we need some additional trade out of China, and that's not going to probably we're not going to make our way there in the next 2 months, 2-3 months. Not saying we can't get there next year, but I don't see it happening in the next 60, 90 days. So we go back to what do you do with your grain? Okay. Some of you out there didn't put any corn in. You probably got plenty of bin space, and you're saying, well, I can do nothing right now. Well, that still may not be your best choice. But if you got to make a decision on what you put in the bin, this really becomes an important thing to think about. Right now, we've got harvest soybeans at 68 under. And as you can see, you saw in that chart before, our average basis at this time of year is $1.10 to $1.15. I mean, it's 40 to 50 cents better than normal. Harvest beans right now are trading under the November. So I got the X there, which is November futures. I correlated this back into getting the May bid, what you can sell for May, with the basis level that I think it will be at May, and also factoring in what the futures carry is, what you'll get, what you're going to get paid to keep beans in the bin today. Did the same thing for corn. 55 to Z is 55 December futures. When you work that price into May under the December, you can see the carry there, and wheat is under September. So let's go back to beans. You can sell beans today at 68 under the November futures. Under the May today, because of PNW values that are drastically lower, because of Brazilian values and Argentinian values that are cheaper, being, you know, there was a slide that Bill showed that I think it was a 90-cent difference in what Brazil would sell today versus what they'll sell for April, May. This is why. You can see it. We're not competitive. We're not the exporter of choice in May. So world exporters are telling you you should be delivering beans today. And honestly, whether you have bin space or not, you should still be delivering beans off the combine. If you choose that you want to have more time to price your futures, I understand that. You can do that. You can lock in a basis contract today, get your beans delivered, lock your basis off a deferred futures month. That gives you more time to price those beans out. But if you wait to haul them, you're literally going to lose 30 cents a bushel with the difference in basis and the difference in futures to May. So don't put the beans in the bin thinking that you're going to see this big return on beans. That's not how it's stacking up today. Corn harvest basis today is 55 under, which is stronger than normal for this area, especially. We rely solely on the PNW right now for corn as well. There are no processing plants for in the Argyle area. I know you've got some processing plants you get in the Southern Valley, but harvest basis is 55 under. The equivalent basis for May today is 31 under, so you've got a 24-cent carry between basis and futures today. In wheat, harvest basis is 48. The May equivalent of that is 9 over the September, because we're going to probably see May delivered basis, I guess, in 28 under area, and you got a 37-cent carry in futures from harvest until May. Total carry between futures and basis on wheat is about 57 cents a bushel. So take a look at your carries, and you tell me what pays more to put in the bin. If you're using bin space, does it pay to put beans, corn, or wheat in there? And you can see pretty easily, wheat is your biggest return on using your bin space. Corn's your second biggest return. Beans, whether you have bin space or not, you're probably going to go backwards by keeping your beans in the bin. So final statements. Generally, this is not every year, but generally your bin space should not be used for soybeans. Now, I will say this. Many times there is, when we get to October, that's our best, that's our worst basis level, okay? So I'm gonna clarify that comment with doing nothing and then hauling beans in off the combine and taking the basis that the elevator has is not how this works. In order for you to capture the best possible use of your bin space, you need to be locking in harvest delivered basis during the summer. Generally, our best basis levels are July and August for harvest delivery. Once we get to harvest, our basis typically is 30 cents worse than you could have locked in July and August. So you can't just harvest them, bring them in, and that's your plan. In order to really maximize your basis and your bin space, you have to forward sell basis for harvest delivery. The other option you have is there is a return on bin space in beans, but generally it's 10 to 15 cents at max to get to December. By the time you put the beans in the bin, pull them back out again, factor in some interest costs, it generally doesn't pay a whole lot to put beans in the bin for December delivery. But there's also times when you might want to dry your own soybeans. Doesn't work toward the elevator all the time. So it's not wrong to put beans in the bin, but you still need to sell December delivery beans, at least the basis portion, ahead of time. That's your best bet. Just adding to that, corn and wheat most years have a much larger rate of return for your bin space. One myth that I hear so often is, I'm going to put this corn or wheat or beans in the bin so I can get the carry. That's a myth. You don't capture carry by putting grain in the bin. That's only one portion of that. Generally, what happens when people put grain in the bin is, when we talk about fair value again, you've put your grain in the bin, the market gravitates towards fair value and steps down towards fair value each time the front month goes off the board. So you've done nothing to capture carry by putting grain in the bin. In order to capture carry, you have to forward sell when there's a carry. And forward selling generally for the best prices is selling 12 to 24 months ahead of time. So it's pretty crucial in times of average to above average ending stocks that you forward sell. Last is, don't be a basis trader. And I know that I've got a bias when I come from a grain company saying that, but one thing I'll caution everybody against is, I've seen this too much over the last 5 years, is growers doing nothing on marketing their grain because they're worried they're going to get a 5-cent worse basis if they lock in a cash contract somewhere, or a futures contract, excuse me. And what happens is they end up trying to bargain with several grain companies so that they can get 5, 6, 7 cents better on basis. But in the end, they had no focus on the futures price. So when I say don't be a basis trader, I'll say this. If you forward sell 12, 24 months ahead of time, and this is not the whole crop, I'm talking 25 to 50%. You can't sell 75 or 100% of your crop that far in advance, but 25 to 50%. And you do it with a grain company you trust. I mean, you guys are all over North Dakota. There's plenty of grain companies that are out there that are trustworthy, good companies. If you do it with a company you trust, that you know is going to be there for you when it comes time to delivering that contract and setting a basis, that is your best bet. If you focus on doing nothing and trying to work with 4 different elevators to get a nickel better basis somewhere, you're focusing on the wrong thing. So work with an elevator that you trust. Form a partnership with them to say, hey, I'm going to sell this to you. I know it's 2 years ahead of time, and I'm going to trust you're going to be there. And keep in mind, it goes both ways. From a grain company's perspective, when we're buying grain 24 months ahead of time, we're trusting you're going to be there for your part of the transaction as well. So it needs to be a partnership, but those partnerships, if you sell the features ahead of time and trust your grain elevator that you can work out a base level, it's going to be competitive later, is going to have the biggest return that you're going to see, and the best way to market your grain. So I know I kind of went over a few different areas. I didn't cover a whole lot of soybean economics per se, but I wanted to come at this from a more of a local level and how you market your grain. And hopefully that was helpful. And if anybody's got any questions, I'm glad to answer.
All right, well, thanks, Jim. I think that was very helpful for our growers. I do have a question here, and I think you may have answered it, but let's just answer it again here. So if you're currently at 68 under for new crop, would you expect that to stay the same, improve, or worsen going into harvest this year?
My guess at this point is, again, when you factor in the for the most part, two pricing components that we have right now. It's the delivered bid that we can get to whatever export channel that we're going to. In our case, it's P&W. And then you've got freight. Those are the two biggest components. What you're going to see, I think, is I don't think that P&W basis has peaked yet, but I don't know that we're much more than maybe if we traded a dime higher in P&W basis, it wouldn't surprise me. Okay, so let's say delivered basis gets 10 cents better. The problem you're going to see with that is freight right now. So secondary car values right now are climbing higher every day. A lot of the business has been done at a local level. When I say that, I mean most grain elevators have all of their freight pretty much spoken for at this point. So whatever freight they owned, it's already sold on a soybean contract or corn, whatever it's going to be, and they don't own anymore. So in order to sell more grain, they got to go out and find more freight. Well, there's not that many willing sellers right now because we're already to a point where we've got October at almost a capacity program. So as we see P&W basis rally, you might see freight values rally more than the P&W bids do. So if we see a 10-cent increase in P&W bids, wouldn't surprise me if we see a 10 to 15 cent increase in freight costs, totally offsetting the positive impact that P&W basis had. So, I mean, the short answer is I'd be surprised if we get a whole lot better from here. If we get 3 to 5 cents better, it's possible. We're going to probably move sideways here. We're going to be limited by the by freight values essentially. You're even seeing CP freight values, which are generally a lot cheaper than the BN, are as high as I've ever seen them here since 2013. But as high as I've seen them in the last 7 years. Part of the problem with that is the CP has not come out with a program yet. They're behind the 8 ball like normal. But there just isn't a lot of freight for sale today that already been kind of already on a grain contract essentially. So yeah, I don't see basis getting a whole lot better. In fact, as we get closer to harvest, and the ports get to a capacity program, they only have so many boats they can load in October. Now we're on to November. We've got some capacity in November. We've got some capacity in December, but the October capacity at the ports is getting to be limited. We got expensive freight, so I would anticipate that basis is sideways, and as we get closer to harvest, it gets worse.
Okay. Thank you. That is the only question I have right now. So if you think of any, keep sending them in. Otherwise, Frayne, if you are still out there, there you are. So we've talked a lot today about basis, trade war impacts. What we really haven't covered today is coronavirus. And Frayne, I think you were going to touch on how all of that may play in here.
I do have, can you hear me? I do have some comments. Let me, if I can pull this up. I've got a couple comments here that I want to make.
Okay, you're kind of quiet, Frayne. I don't know if there's, and people can just turn up the volume, but you're just coming in a little bit more quiet than Bill was.
Is that better?
Better. Yes.
All right. So let me just talk a little bit about coronavirus, and I'm going to skip over a lot of this stuff just for the sake of time, because I know we only have a few minutes left. One of the challenges with this COVID-19 and a lot of the people in the industry right now are trying to decide what kind of shifts are we seeing in consumer behavior, not only domestically but globally. And then how are those shifts going to be permanent, or are they going to be temporary? I know, there's some comments made on, Bill made some comments earlier about, some of the shifting demand and with the example of the DAPL, so a lot of companies are facing that kind of condition. It's like, we've seen these big shifts. We're trying to accommodate these shifts temporarily. The concern is, do we make some infrastructure investments because we expect these to be permanent, or are they going to be temporary? You know, when all that relates back and translates back to the farm level, it gets muted. There's a lot of the information that and the shifts that we're seeing on the consumer side don't make it all the way back to the farm level. And I know you guys are really concerned right now about what's going to happen at the farm level. So please, just number one key takeaway, understand there's a lot of questions going on right now in the food supply chain, in particular on the meat side, and consumer chain shifting in meat and meat consumption habits, whether this is going to be a permanent shift or a temporary shift. In my opinions, a lot of these are going to be permanent shifts, just because the coronavirus has been going on long enough that we're changing our habits, and once we change our habits, it's kind of hard to go back to the old way of doing business. This is the last piece that I want to talk about, and this is something that could potentially impact you as farmers and farm managers as we move forward in time. A couple things about the potential for continued shutdowns or a return to shutdown. Number one, I want to remind everybody, U.S. agriculture and the transportation system are considered essential services. And so they operate under a different set of shutdown orders, or they have a different set of criteria they use for shutting down. I don't expect any major system-wide supply chain disruptions because of COVID, but I do think we may see some company-specific shutdowns. And what do I mean by that? I've talked to several processors, as well as some of the local elevators and kind of agronomy centers within the region, and talked to some of their general managers, CEOs, and there's a lot of concern about what happens do we do internally if our employee base gets sick. What happens if all of a sudden we have, you know, of the 30 employees or 40 employees we have in our company, what happens if 10 or 15 of them get sick in the middle of harvest? And that's a real concern, especially as we move into the fall time. We start coming indoors, we start spending more time indoors. If we start to see a surge in coronavirus and employees getting sick, what do we do? How do we adjust for that? And I know there's a lot of kind of back behind the scenes things going on within a lot of the elevators, the processing plants in the region, trying to plan for what are our contingency plans, how do we deal with this? In my view, I don't think we're going to have a lot of rail disruptions because of coronavirus, where all of a sudden crews get sick and we see a lot of disruptions that way. I do think the rail industry is set up for pretty well to manage this. We may see some in trucking, especially if you're looking at local input or output supply chains. There might be some of the truck traffic that gets disrupted. There are some concerns about export facilities. I don't think in my personal views, I don't think we'll have much problem or disruptions in the U.S. system. There have been some concerns coming out of Brazil as well as Argentina for some of their some of their major port facilities, and right now, it's all been about worker strikes and concerns about worker safety. But again, if there gets to be a major outbreak, there might be some supply disruptions that cause some heartburn and some problems as we move forward. And obviously, those are shocks to the system, which means that prices can adjust very, very quickly, including basis levels as well as the underlying futures markets. So with that, I know I'm about 1 or 2 minutes over, which is normal for me, so I'm going to stop right there, and we'll go back to the conversation. So those are some things I just wanted to talk about as we move forward.
All right. Well, I still don't see any more questions coming. If anyone's typing, we'll just wait a little bit here to see if something comes in. But I just want to thank everyone for joining us, especially if you've been here both days. If you weren't able to make it yesterday, we are going to make the recordings available. More communication to come from us on that, so watch your emails. Otherwise, again, I just want to thank our panelists. I want to thank Jim today. We had Daryl yesterday, and always Bill and Frayne for their help. We're very fortunate to have you all as resources for our growers. So. with that, I don't see any more questions. So I think we'll log off here. So thanks everyone again for coming. Got just a thank you coming in to the chat box here. So everyone, we hope you have a safe harvest season and a profitable one.